So based on what we started last week, we started with the concept of value-added tax, VAT, value-added tax, which I was able to introduce some aspect to us last week. So we are going to continue with this. So I have shared the material as well. So the material for value-added tax, we already have it on the group, and also I've also shared it on the screen. So as I said last week, that's what value-added tax is a consumption tax. Unlike our personal income tax, company income tax, capital gain tax, this value-added tax is a consumption tax that is charged on what? Goods and services. It is only when you buy goods and services that you will be liable to pay value-added tax, the tax. If you don't go to anywhere to buy goods and services, nobody will ask you or will require you to pay any money for any tax relating to value-added tax. Before now, it usually charged at the rate of 5%. But from February 1, 2020, it has been increased to what? 7.5%, which is the applicable rate that is available now. And the tax is collected by only the Federal Inland Revenue Service. Only FRS is the only tax authority who collects what? Tax relating to what? Value-added tax. So only the FRS is administered to collect it. And according to the tax law, it is usually paid at the various stages of production. So when the goods is moving from the supplier to the manufacturer, there is going to be, when the goods is moving from the manufacturer to the wholesaler, there is going to be a VAT that will be charged. From the wholesaler to the retailer, a VAT will also be charged. Then retailer to the final consumer, they will also charge VAT. So the final body will now be borne by the customer. It is the customer that will bear what? The final burden of the tax, so which we talked about last week. So we also made mention, I also explained to us the concept of what? Goods and services. So where I told us what the tax law has defined what goods and services means. Any form of a tangible property that are movable or immovable, something that is tangible. But it does not include land and building, money or security. So in essence, the implication of that is that if you are selling your currency, it will not be chargeable to VAT. Or if you are rent, which involve land and building. If you build a house now, so you are paying rent. So that will also not be subject to a value-added tax. So we also talk about services. So we said is anything other than goods provided or under contract of employment. That is, if you are an employee, employer-employee, salary that is your employer is paying you will not be liable to what? Value-added tax. Then any intangible or incorporeal products or assets over which a person has ownership or rights is also regarded as services. So excluding interest in land, building, money, and security. So it's also regarded as services. So all this has been discussed in the last class. So I just need to refer to them again so that we will. So today we'll be starting from page 2, which I believe, so page 2, which is objective of VAT. Objective. So what are the objective of VAT? So what are the reasons? So you may be asked, what are the reasons or objective why government decided to introduce value-added tax? So government, they need money to carry out the various economic activity. So one of the objectives is to generate to increase government revenue. So the value-added tax can be used to increase the revenue of the government. So government use that to get more revenue. So also to make your tax system more transparent with value-added tax, you know that yes, if I buy any goods, this good is subject to to value-added tax. Why this one is what? Is also not subject to value-added tax. Another important issue is to reduce tax evasion practice, because they find out that if those taxes are not levied on those goods and services that are being, so nobody will be willing to pay those taxes. As a result of that, government came up with what? With the value-added tax. Also to increase what? Export. Because basically, any exported goods is excluded from a payment of what? Value-added tax, which you are still going to talk about. So those are some of the objectives. Then we also have the fixtures. So the fixtures are, in the fixtures is what I have explained earlier. So the first one is talking about that is a consumption tax. Second one is saying, it's a multi-stage tax system. That is, it is charged at what? Various stages of production, from production to the distribution channel. Then it is also the third one, was initially invoice-based, but now was cash-based by the Finance Act. So before now, value-added tax is usually, VAT will be charged, whether the customer is what? Is making the payment or not. That value-added tax will be what? The agent will be liable to make the payment. But now, it is not like that. Payment will be, value-added tax will be due only when what? When payment has been received. So when you are giving out the invoice, you are expected to charge the value-added tax. Before, immediately you have charged the value-added tax, whether payment has been received or not, you are supposed to remit to the relevant tax authority. But now the rule is that it is not until when you receive the payment. So when you now receive the payment, that's when you now remit to the relevant tax authority. I also made mention earlier that that's what rate, it was initially 5%, it has been increased to 7.5. So those are what the fixtures. So after the fixtures, we have principles of VAT. So basically, there are two principles guiding VAT. We have the origin principle. Yeah? Hello, any problem? Any problem? Somebody is talking. Hello? Hello?
No problem, sir.
Okay. Okay. Yeah, thank you. Okay. So principle of value-added tax. So we have value-added tax are two principles, which are the origin principle and destination principle. Those are the two principles guiding what value-added tax. Origin, as the name implies, that implies that value-added tax will be charged on wherever the goods or the services is coming from, is being produced or consumed. Wherever the goods is being produced, the value-added charge is going to be charged. That is, it is what? Origin, where the good is being produced or where the services is emanating from. Whether that goods or services is going to be consumed in that location or not, the value-added tax will be charged. When an organization or when a country adopts origin principle. So most of these advanced countries like China adopt origin principle. Most of the goods that come from China has already been charged value-added tax before we're coming to. Because why? Because most of that company, they are already developed countries. There is no way, even though if they put those products, you will still go to them because there is no other place that's where you find those products. So origin principle implies that what value-added tax will be charged on what? Wherever the goods is being produced. Whether that goods or services is going to be consumed in that location or not. So this particular principle is not adopted in Nigeria. But most of these advanced world, that is the principle they adopt because they are producing countries. Then the second, we have a destination principle. So this implies that value-added tax will be charged only at the location where the goods or services is being consumed. It will be charged at what? The location where the goods or services is being consumed, rather than what? Where it is produced. So that means, so this is the type, destination is the type that is adopted here in Nigeria. So the implication of that is that any goods that is produced in Nigeria and it is meant for export is not going to be what? Charge what? Value added tax. So the bottom line is that what? All exported goods are not what? Charge what? Value added tax, because what? Nigeria adopt what? Destination principle. So is that clear to us? So before we proceed further, so there are some things that we need to know under this what? Value added tax. So which are some basic characteristics or basic terms that are common to value added tax. One of them is your VATable activities. VATable activities. So when they say VATable activity, in simple terms, those are what? Those are goods or services that are what? That are liable to what? Payment of VAT. That is when you engage in what? Those activities that are liable to what? To payment of VAT. So that is those transactions that are taxable. And those transactions is not only, it can be transaction of club, it can be transaction of organization, it can be transaction of government authority, ministries, and so on and so forth. Any transaction that is chargeable to VAT are regarded as what? VATable activity. Then the second term is what we have: taxable person. Taxable person. So those are people, those are the what? The taxpayer who trade or deals in what? VATable goods and services for what? For a consideration. That is when you are a company now. When you sell goods that is VATable, so you are regarded as a taxable person. So it is your responsibility as a taxpayer who deals in what? VATable activity to what? To charge VAT on that goods and services that what you are selling. So taxable person are those what? Who trade in what? VATable goods and services for a what? For a consideration. So when you now trade in those VATable goods and services, the VAT that you collect is not your money. So you are expected to what? To remit it to what? To the relevant tax authority, which I mentioned earlier. Who can remind us who is the relevant tax authority for VAT?
FIRS.
FIRS. So it is expected that you remit what? That's the person will remit any VAT removed from those activities to what? To the Federal Inland Revenue Service. So, there is also a time limit for remittance. So we are still going to talk about that. Then we have what? The next one, VATable period. VAT is expected to be paid. It's usually for a period of 1 month. VATable period is a period of 1 month, commencing from the beginning of a month to the end of a month. Then the implication of that is that any transaction you do from January 1 to January to 31st of January, it is expected that what? Those transactions should be what? Accumulated together, the total VAT calculated and remitted to FIRS on or before 21st day of the following month. The implication of that is that as a taxable person, any transaction you sell that attract VAT from January 1 to 31st of January, you have from February 1 to 21 February to remit that money to FIRS. Failure to do that will be liable to what? Penalty and interest. So after that, we have what? Input VAT. Because you are selling now, you are selling those things that you want to sell. Those things does not emanate from heaven. You also that want to sell, you also buy those things from somewhere, or you buy some raw material to produce those items that you want to sell. So that means by the time you are buying also, the person that is going to sell to you is also going to charge you certain amount of VAT. So that amount that is being charged is called what? Input VAT. So input VAT are what? VAT paid on what? Purchases. Any VAT that you are paying on item that you purchase as a what taxable person is called what? Input VAT. So in simple terms, input VAT is what? VAT on purchases. Then we have what? Output VAT. But you want to sell now. It is, they said, well, you must what? Charge what? VAT on what? Anything you want to sell. So when you charge VAT, that VAT is expected to be remitted to FRS. So that VAT you charge on your sales is called what? Output VAT. So in simple terms, output VAT is what? VAT on sales, while input VAT is VAT on purchases. Then we have what? VAT return or VAT payment. We said what? When you sell, you are going to what? Collect what? Output VAT. When you purchase, you are going to pay input VAT. The difference between your output VAT and your input VAT, when your output VAT is more than your input VAT, the implication is that means what you collect from FRS, what you collect. Hello? Hello?
We can hear you, sir.
Okay. So what I'm saying is you have a VAT return or VAT payment. That is your output VAT, what you collect when you are selling in form of VAT, minus what you pay when you are buying that item you want to sell, is what is called what? VAT return or VAT payment. So that means when what you collect is more than what you paid to what? To get that item that's what you sell. When your output VAT is more than your input VAT, so that means it's expected that what? You have to pay what? The difference to what? To Federal Inland Revenue Service. So the difference between what? Output VAT minus input VAT is what is called a VAT return or VAT payment. In some instances, you may also have refund. Refund in the sense that when I sold the item, I sold it, I collected VAT of only 10,000 naira. But when I was buying the item, the person who sold the item to me has already charged me a higher amount of VAT. Let's say he has charged me VAT of 15,000 naira. That means I have paid more than what I collect. So the difference between where your input VAT is more than your output VAT, that is what VAT refund. That means it is expected that what FRS should what? Should refund an amount of money back to you. And that refund will be taken through what? Through subsequent tax credit. So that means if what you suffered is more than what you collect, you are expected to get what? It will not be a waste. You are expected to get what? A return, a refund, which will be what? Which will be used to what? To reduce your what? Subsequent VAT payment. And you can see that means for VAT, we can remove our what? Output from where? From our input VAT, unlike withholding. You know when we did withholding, we said what? Your withholding claimable cannot be what? Removed from your what? Yeah, from your, yes, payable. So they are separate items. But in the case of VAT, both of them can be what? Can be removed from where? From one another. So let us take note of that. Then another one we have of taxable supply.
Hello, sir.
Yeah?
Sorry, sir. I just want to be sure of something. This VAT return, is it the same as reverse VAT?
Is what?
Is it same as reverse VAT?
Reverse VAT. No. It's not the same. Don't worry, I'm going to explain that one. It's not the same. VAT return is where you are paying. Reverse VAT is another thing entirely. I will. So then we have what? We also have taxable supply. Taxable supply. Any transaction that you are selling, which you are going to what? Which you are going to get money from that transaction, whether goods or services, that you are going to receive a consideration from that what transaction is regarded as a taxable supply. Any transaction you are doing at all that you are going to receive consideration as a result of what? As a result of either selling that product or either what providing that services is called what? Taxable supply. That means what? You have done something for somebody and that person is going to pay you. When the person is not paying you, it is not your taxable supply. It is when you are paying, the person is going to pay you, so it will be what? Taxable supply. Then we have what? VAT exclusive. When they say VAT exclusive, as the name implies, exclusive, please, the implication is that the VAT amount is not included in that what? In that figure given to you. Let's say they give you a figure of 100 naira. So that means the VAT component, that 100 naira is just only the invoice amount. The VAT component is not included in that 100 naira. So when you are given a figure that is VAT exclusive, how do you calculate the VAT? We know that VAT rate is 7.5%. What you just need to do is to multiply the 7.5% by what? By that amount. Which is what? The amount you are giving, multiply by what? 7.5 divided by 100. That will give you what? The amount of the what? Of the VAT amount. The examiner can also tell you that it is what? VAT inclusive. Look at that word, inclusive. That tells you that what? The VAT amount is already included in the figure given to us. VAT is included in the figure. That's what they mean by inclusive. So where VAT is included, that means instead of that amount given to us to be at 100%, the amount will be at 100% plus the VAT percentage, which is 7.5. If you add 100 plus 7.5, that will give us 107.5. So that means the total value given to us is 107.5. So in that instance, how do we now calculate the VAT? So if you have VAT inclusive, that means to get the VAT amount, it will be what? The invoice, the value provided multiplied by 7.5 divided by 107.5. Please let us take note of that. But in the question where the examiner is silent, you may have a question where the examiner did not tell you whether it is VAT inclusive or VAT exclusive. Please, where the examiner is silent, assume VAT exclusive. Do we get that? So where the examiner is silent, we assume VAT exclusive. So then another terms that we need to consider is what we have a tax point. Under the tax point, we have a basic tax point. That is, this one is talking about the period, basic tax point, the period in which what the VAT is payable or claimable. When will the VAT become due? That's what they mean by one. At what point is the VAT amount due? So at what point is the VAT amount due? So for goods, VAT will be due when that goods is being removed from the warehouse or where payment is made, whichever comes first. That is, the basic tax point for a supplier of goods, the day the goods are removed, sent to customer. If the goods are not removed, it is the day they are made available for his use. That is the tax point where a goods will become VATable is when that goods is become. Hello? As a manufacturer now. Hello, can we hear me? Hello?
Yes, sir. We can hear you,
Okay.
sir.
So what they are saying about the basic tax point is now for goods now. Let's say as a manufacturer now, if you have produced a goods, you have produced some goods. If those goods are still in your warehouse, you are not liable to any payment of VAT. It is until when those goods leave your warehouse. That is when somebody has come to come and buy those goods. That is when that goods will become liable to VAT payment. Do we get that? Then the services, the basic tax point for services is the date the services are performed. For instance now, where you want to perform a service for somebody, so that service will become more VATable on that day. That's what the commencement of that services begin. So that services will become more VATable. So on the person that is providing the service. Then the next one, we have an actual tax point. So under this one, the actual tax point is When are you supposed to charge the VAT? That is the date that you are giving them or the invoice. It is usually the invoice date. That is that day that you make the agreement. That is the date that that service become vatable. So the invoice date, that is the date you enter into agreement and gave that person an invoice that yes, we are entering into agreement. So this is your invoice. So for giving you that invoice, it's expected that that person will pay. So, but where you are giving him invoice, where the person did not make payment as at the date the invoice is being paid, that means that it's not going to be what? Any tax point. So the tax point will now be what? The earlier. Between what? The earlier, there is an earlier actual tax point created at the time the invoice is issued or payment received. So that means, for instance, now you have issued an invoice, the person is here to pay, to make payment. So that means what? There is going to be what? So you now wait until what? So the point where that transaction become vatable is as at the date of what? As at the date of that invoice. But for payment will now come when the person now pays you the payment of what? Of the value added tax. So it is also possible that what? Your goods and services may not be supplied at once. It may be supplied continuously. So where services or goods are supplied on a what? On a continuous basis and payment are received regularly or from time to time, there is a tax point every time a VAT invoice is issued. Maybe the services you are rendering is not once. As you are rendering the services, you are issuing an invoice. So immediately you are issuing an invoice, a VAT invoice is issued. So that means there is going to be what? A tax point as at that time. Or whenever payment is received. Maybe it is when you render the service that they are going to pay you. So when they pay you, it's also expected that you must also deduct and remit to the relevant tax authority. So in summary, the summary of what we just mentioned on the tax point is what we have here. So in situation like this where there is no invoice needed, so it will be what? Where invoice is not needed, that means the date you are supplying the item. Where VAT invoice is issued, date of invoice. Where payment or invoice issued in advance of supply, date of payment or invoice, whichever is earlier. Payment in advance of supply and no VAT invoice yet issued. The date date payment received, any day. Where you are even yet to issue VAT invoice, but the person has already paid. That item is already vatable on the person. So as a taxable person now, I know that I deal in vatable activity. Do I just say, okay, do I just start any day and say, yes, I can be deducting? Or what are or do I need to register with what? With the relevant tax authorities. So that is what? Registration procedure with what? With relevant tax authority, which is a registration of taxable person. Please, a taxable person, according to the Act, is expected to register within 6 months upon commencement of business. If you are commencing your business now, you are expected to register for value added tax within 6 months upon commencement. Initially, Finance Act 2019 changed the process to upon commencement of business, but now it has also been extended to 6 months upon commencement of business. So that means if you are a businessman now, you are registered as a business, whether as a company or as a limited liability company, it does not mean whether you are not a company. That does not say you cannot charge VAT. So as a limited liability company or as an enterprise, once your business has been registered, either as a business name or as an enterprise, you are expected to go to visit the nearest FRS office to register for VAT purpose. So registering, they will now give you certificate as certificate of deduction for VAT. Also, government ministry and agencies, they are also expected to register for VAT because they are also VAT agent for deduction of VAT. So they must also register. We have some companies that they have branches. Like, let's say, for instance, now we have Nigeria Bottling Company, NBC. manufacturer of Coca-Cola. They have plants in Lagos. They have in most especially major part of in Nigeria. They have all over the states, majorly all over the state in Nigeria. So how do we? They now said you should register with the nearest what FRS office, and this company is one single company. Please, for any taxable person that is having various outlets, it is expected that what for those various outlets you also register with what with the nearest FRS office. You are going to register that your what those various outlets with the nearest FRS office. When you register with the nearest FRS office, your TIN number will still be the same because the company is just one. But the reason why they want you to register with nearest FRS office is that so that what they will be able to what to monitor you and look at your record regularly. Than if they say, okay, a company is having maybe Coca-Cola now that their head office is in Lagos State. They have another branch in Abuja, they have in Port Harcourt. So it will not be easier for FRS to be moving, the staff of FRS in Lagos will be moving from Lagos to Abuja again to go and verify what records of those in Abuja. So that means the FRS office located at Abuja, that is closer to that office, we have we'll be able to carry out the activity. But by the time it is just a single company, but they are just dividing their transaction based on based on the various outlets. So that means if you have more than one outlet, it's expected that you must register those outlets separately for with the nearest relevant tax authority for VAT purpose. Any question? Any question? Any question? Any question? Are we still with me?
Yes, sir, we are here. No
Yes,
question.
sir, we are with you. No
You
question.
guys are not responding now. Please respond.
Sir, we don't have question for now.
At least I expected that. Okay, no question. Thank you. So the next one we have as you are expected to register, it is also when we did basis of assessment, we talk about cessation of business. When something happens, it's possible that company with taxpayer, whether individual or company, they may decide that they want to stop their business. It is also expected that when you stop your business, you also inform FRS of that information. That is called the registration for VAT. Because you are registered for VAT, when you are stopping your business operation, you must also inform FRS within 90 days afterwards, after cessation. After you have ceased operation, you must also write to the nearest Federal Inland Revenue Service where your VAT registration is located, to tell them that yes, this company we have ceased business as a so date. Failure to do that, the company will be liable to penalty and interest. So you are also expected to inform the tax authority FRA that this company has also ceased operation within 90 days afterwards, after the date of cessation. So let us take note of that. If failure, there's going to be a penalty and interest. So for failure to file return. So those are the ones. Then after you have registered, it is expected that you keep account. You must keep account of all activity relating to VAT transaction. That means as a taxpayer, after you have registered for VAT, the law made it mandatory on you to keep record of your books. It is not a matter of I don't have accountant, I don't have this. It's not an excuse. You must keep record of all the books so that when the FRS come for audit or VAT visit, they will be able to trace to look at your record and know whether you are paying the VAT that you are supposed to pay or not. Also, failure to keep record is also an offense, which also attracts penalty. So, and if you are keeping record, as we said earlier, that's by the time you charge somebody, you are selling, you charge person, that is going to be a VAT invoice that you are going to issue. That VAT invoice is called a tax invoice. That invoice will be like, it's part of your receipt when you are issuing your receipt. So the name of the what did you say?
I don't like remitter.
Yes. The name of the taxpayer will be there, the tax identification number, all those information will be in what? In the tax invoice that will show that, yes, this is the amount of VAT that I collected from this also person. This is the person from this also sales. This is the amount of tax I charge them. This is the total value of the sales. This is the value of the VAT. This is what is due to FRS, and all those information will be stated in your tax invoice. Those are the. So the Finance Act. So after the Finance Act 2020, now introduce some new introduction relating to VAT, which is called what? Tax threshold. Why? Because under VAT, under the tax law, we have three categories of company, which are what? Small company, medium company, and large company. For small company, they regard them as company with turnover of 25 million and below. Those companies are exempted from payment of tax. Their tax rate is 0%. For medium company with turnover of above 25 million naira and below 100 million naira, they are regarded as medium company. Their tax rate is 20%. And the third category is large company with turnover of 100 million and above, 100 million naira and above. They are called what? Large company. So those three categories, because small company now, they have turnover of 25 million. And you know the tax law, I said their tax rate is what? 0%. They are not going to pay tax. So by implication, small company, they are also not expected to what? To charge VAT. They are small company, they cannot charge VAT. But they can what? They can suffer VAT. Because as a small company, that does not say you should what? You should deal only with small company. As a small company now, that you know that your turnover is below 25 million, you can also have dealing with what? Either medium or large company. And when you deal with those ones, they are what? Mandated to charge. They are going to charge you what? Value-added tax. So because you cannot charge when you are selling, so that means you will not have output VAT. You will only what? Suffer what? You will only suffer input VAT when you deal with what? With either medium or large company for buying from them. So as a result of that, any input VAT that you now suffer will be what? Will be refunded back to you by FIRS as a small company. Once it has been established, that's what there is a refund. That refund is established. It will be refunded back to you. And this 25 million naira we are talking about is not for a month. That is when your sales when your turnover throughout the whole year is what? Is from your accounting period. If you are using January to December, 12 months is what? Is 25 million naira and below, not for a month. Please, let us take note of that. So when your transaction is what? 25 million naira and below. So that's what they mean by what? So that means, so the threshold now is that when you now have what they mean by that threshold is when you have a turnover of 25 million and below. In a year, you are not what? Liable to what? To charge VAT. So in that case, you are not expected to charge VAT. So let us take note of that. So then how do we, so there is a rule guiding what? This threshold.
Sorry, sir.
Yeah?
If it's above 25 million,
you are going to charge.
How much charge?
Yeah, you charge 7.5%.
And above 40 million.
Yeah, you also charge them. The rate is flat, it's 7.5%. This 25 million is your turnover. You know, this turnover for the whole year, it may not be its once that you are going to sell that time. Maybe in a month, you sell 2 million. But you know already that as at the end of that year, you are not going to get up to what? Up to that 25 million. You are not expected to charge at the beginning of the year. So when the law now came, the law now brought how do you determine that? look at under that page as well. If you look at the material, there is a place I'm going to look at it. The first one, number 1, determination of, can we see that item I highlighted? Hello? Can we see the item I highlighted?
Yes, sir.
Yeah. If you look at it, say a taxpayer, a taxable person who has made taxable supply of 25 million prior to the introduction of VAT threshold shall continue to charge, collect, and remit VAT and file monthly return, even if it has not made 25 million taxable supply in the current year. When the law came up, it is now believed that once before this law, before this Finance Act 2020, in the previous year, if your total turnover, your taxable supply has been more than 25 million, you are expected to continue to charge VAT. Even though, as at the time that law came out, even though where you are yet to reach that 25 million, the law has made it mandatory for you that you must charge what? VAT. Because what? You have already reached more than what? The threshold in your what? In your previous years before what? Before the law came out. Then the second one, a taxable person who did not attain 25 million taxable supply before 1st February 2020 shall immediately commence to charge, collect, and remit the tax and file monthly return upon attaining what? The threshold of 25 million taxable supply at any time within the year. For instance, now, last year, in 20,
sorry,
yeah?
Why February? Why February?
That was when the commencement of this threshold was introduced. The commencement of the Finance Act 2020.
Okay.
So, look, this is
Hello,
what they
sir.
are saying. Yeah?
Sorry, sir. You mentioned that for middle company, their company income tax is 20%, and then for large
Yes.
companies it's 30%. So
Yes.
for small companies, how do they charge their own
It's
CIT?
zero. They don't pay tax. They are exempted. It's 0%. Zero.
Okay, so
Zero.
where does the 0.5% of actual turnover come in?
0.5%. That is minimum tax. That the
Yeah.
0.5 is minimum tax. Minimum tax. It's
Yeah,
not
so they
applicable.
are not supposed to pay that minimum
It's
tax.
not. Yeah, it's not applicable to them. Don't
Okay.
worry. When we get to company income tax, we are going to talk about it deeply. It's not
Okay, sir.
applicable to them.
Thank you,
So
sir.
this next one, we have 2021. In 2021, your turnover, total supply you made did not get to 25 million. That means when the threshold started, you have not attained 25 million. So as at in 2019, you did not get to 25 million. Throughout 2019, January to December, your total taxable supply did not get up to 25 million. That means you are. So when the law now begin, February 1, 2020, it is expected that as at that February 1, 2020, you are not expected to charge any VAT. Because why? You did not what? You did not attain the threshold in the previous year. But between that January to December 2020, if within that year, maybe as at June, your transaction now gets up to 25 million. From that June, you are expected to start charging value-added tax. Is it clear to us? So from that June, upon attainment of any time that you get to that 25 million within the year, you are expected to start charging what? The value-added tax. Then the third one, we have a taxable person may voluntarily register, charge, collect, remit the tax, and file monthly return to FRS at any time, even without attaining 25 million. Such a person shall notify FRS prior to doing so. Also, as a taxable, if you know that, okay, maybe last year you did not get to 25 million, but you know that this year you have a prospect of a particular project. The law says you should not charge, but you know that you are still going to get more than 25 million. Get to that limit, more than 25 million. So you need to you have a right to start charging voluntarily. But before you do that, you must notify FRS before you start charging such value-added tax. Then a taxable person who has not attained 25 million threshold but expect to attain. This one is when you expect to attain in future year, within what a calendar year shall immediately commence to charge monthly return to FRA. You maybe in February, as of February now, your total taxable supply is 4 million. Total, both January and February added together. But in that, at the end of February, you now receive an order that you are going to supply an item that is worth more than 25 million, which means that in that same year, you are going to what? You are going to exceed that 25 million naira threshold. So that means upon receiving that item, upon receiving that order, you are expected to start charging what? The value-added tax. Then we have a taxable person who makes taxable supply amounting to 25 million and above within a calendar is required to file monthly tax return. Therefore, even if part or all of such supply are exempt from VAT, yes. If we have some items that are exempted, even though if those items are exempted, it is expected by law that what you must what? Once that item, all your item is more than 25 million, you must also what? File a return to what? To FRA. So when you are now filing, you now file a nil return because of those items are not liable to what? To value-added tax. So please let us take, as I told you, a calendar year is what? A period of 12 months, beginning from where? From the beginning of the accounting date of the company to what? To the end of the accounting date. So we have some illustration there. Let us look at one of them. So before we proceed, we have what? Illustration on page 6. Are we there? Page 6.
Yes, sir. Yes, sir.
Mr. ABC, a wholesaler, supplier of consumer goods, commenced business in January 2020. Look at that one, commenced business in January 2020. By the end of January, his taxable supply amounted to 10 million naira. Furthermore, his taxable supply increased to 18 million naira in February and 26 million in March 2020. When will Mr. ABC be expected to register, collect tax, and file monthly return? Based on the analysis we did earlier, who can tell us when do you think he will start collecting VAT and file return?
It says 6 months after commencement is when you're supposed to register.
Yes, okay.
For VAT. So
Yeah.
at that point, since it's 6 months after and it commenced in January, so that means by June it's meant to start remitting, deducting and remitting.
Yeah. But by that June, you have to look at it that transaction, is it more than the threshold? If you look at from January is 10 million, February is 18 million. If you add the two, 10 plus 18, that is how much?
Now, please repeat what you said. Your network went off.
In January, his total supply, 28 million, which has what? Even exceeded what? The threshold. So that means it's expected to start 6 months after, which is what? From June 2020, he expected to what? To start what? Remitting and what? Filing return to what? To the relevant tax authority. So please, let us take note of that. So because what? Even though, because assuming after that 6 months, it's yet to get to the threshold of 25 million. It's
Hello,
not going
sir.
to, yeah? Hello? 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 Any problem? So that is so as I, hello, any problem? Hello? Can somebody respond to me?
I think I network.
Network.
Our own network, yes. Because
Hello, sir.
Okay.
Yeah, I'm back. Sorry. So as we were saying regarding that illustration, you said that I mentioned that 6 months after, and then you said things we started making from January to that month, or it made 18 million. That's 28 million.
Yeah.
So at the point at that 6 months that he wants to start remitting, he would will it start charging from that commencement date now?
Yes. So look at it. This is it. The law says 6 months.
Yes.
But when the law now introduces this threshold, before, when the law put 6 months, there was no threshold. When the law now introduced the threshold has abolished that 6 months. That means if you are able to meet up the threshold before that 6 months, they said, well, within 6 months, you must register within 6 months. They did not say until when it is 6 months, within 6 months of commencement. So the law, so that within is that what you can decide to register the first month, you can register the second month and the third month. So the implication of that is that what this company, if you look at January, as of January 2020, this one is not going to charge any VAT.
Yes.
But as at February 2020, if you add 18 million plus 10 million, the man has made 28 million, which is more than the threshold.
Yes.
That means from that February 2020 is expected to what?
So deduct and remit.
Yeah, to deduct
charge,
and what? And charge VAT. Yes. Look at it. You're expected to do what? To deduct and charge VAT from where? From February 2020. Please let us take note of that. It's expected to what? Deduct and charge. So from February 2020. So that means what? It's not going to file return from where? From
Sorry, sir.
21st of...
Can we all mute our this thing? There is a fan that is disturbing the class.
Please let us mute our... That person should please mute. Thank you. Yes. Okay, look at it. So that person, the law says within 6 months. I wanted you to learn before I will. So because the law did not say 6 months after, it's within. So that means if you have, so, and that within is what? Before the threshold. The threshold now, when it was now introduced, it now stated that upon reaching the threshold, you must start what? Charging. Do you get that? So that means they said by the end of January, its taxable supply amounted to 10 million. Furthermore, its taxable supply increased to 18 million in February. That means what? The solution we even gave earlier is not correct. Look at it. Not that it made 18 million in February. It's increased to 18 million in February.
Yeah, okay.
It's increased, not that it made 18 million in February. It's increased to 18 million. Is 18 million? Please, let that person mute his speaker now. Is 18 million up to the threshold?
No, sir.
No, sir.
And in February, and 26 million in March. 26 million is more than what? The threshold. So that means this particular Mr. ABC will start charging VAT from when?
March.
Yeah, it will start charging VAT from March 2020. Please let us take note of that. It's going to start charging VAT from March 2020. Not February. That February, I was thinking they said it made taxable supply of 18 million. So that was why, but they said it increased. So that means it was 10 million in January. In February, it was 8 million. 8 plus 10, that is 18 million. So in March, it now increased to 26 million. So that means it's going to start charging VAT from when? March 20 what? 2020. And when is he expected to file return?
21 days after.
Yeah, which is what? What will be the date?
April 21.
Oh no, before what? 21 April 2020. You must give them all this because they said Mr. is expected to register when? They expected to register as at what? That's March 2020, and charge VAT as at March 2020, and what? File monthly return from where? April, on or before what? 21 April 2020. So I hope that is clear. Yeah?
Yeah, before we move forward. So since it's expected to start charging from March and then to remit by 21st of April, or not before 21st of April, his filing now will be from 1st March to 31st March, right?
Yes. Those one for
Okay.
January and December will not be liable to VAT.
Okay, sir. Okay. Thank you, sir.
It's only the one for January to March that is going to be subject to VAT. No, because those one will have gone already.
January.
Those one, sorry, from 1st of March
March,
to end of March. Those for
Okay.
January and February will have
They
gone
will not be
already.
liable.
Yeah,
Okay.
will have gone already.
Okay, sir.
So that's settled that.
But sir, if
Yeah.
the question says from March 2020, does it mean we have to start from 21st of March?
If the question say March 20, no. I explained earlier that what a calendar vatable period is a period of how many months? 1 month.
Okay.
From January to 1 month from the beginning of the month to what? To the end of the month. Whether that transaction occur on the last day of the month is also the same thing with what? Transaction that occur at the beginning of what? Of that month. You are expected to remit it what? On or before what? 21 day of the following month.
My question is this, sir. If the law starts from the 15th of March, 15th of February, 2020, that means before 21st of March, the preceding month, we have to send the returns.
Yes, yeah.
And another a separate returns will be for March.
If the law starts when? I don't get your question.
If the question says the law starts from 15th of March.
Question cannot tell you that.
Okay.
The law starts from the day of the law cannot change.
Okay.
Do you get that? The day of that law cannot change. What can change is what? Is the threshold, when the company is going to reach threshold. Do you get that? The day of the law is what? 1st of February, 2020. It cannot change.
Sir. So I have another question, sir.
Okay.
So if your turnover, the total turnover for March now is about that 28 million, and then like he asked that the major thing came in around that 20, and then you explained that it's just from the beginning of the month to the end of the month. So now it's expected to, and his whole turnover is 28 million at the end of that March. He's expected to just charge 7.5% of that 28 million, right?
No, not 28. You know that 28 million does not relate only to March. It will charge VAT on only the one relating to March only. Because the one for January, the person that bought it will have even used it. The one for February is already gone. It has already been settled. It's only the one for March, because it has already reached the threshold. That's what, it is still within the same month. So only the one for, and if you look at this illustration, the one for March will only be 26 minus 18 million. That should be how much? 8 million, Abi? How much?
Yes, 8
million. So that means VAT is only going to be charged. In March, it's going to charge VAT of 7.5% only on what? 8 million out of this total turnover of 26 million.
Okay, sir.
Is it clear now? Is it clear to us now?
Yes.
Please let us take note of that. Then also let us proceed further. Going to page 7 now. The Finance Act 2019 now introduces what is called self-accounting provision. Self-accounting provision. This is applicable to non-resident company and small company. You know, when I was explaining that threshold before, I told you small company that turnover is below 25 million. Are they expected to charge VAT?
No, sir.
No, yes, you cannot charge. But please, the law now introduces what is called self-accounting provision. This self-accounting provision is applicable to small company and non-resident company that have no fixed base in Nigeria. So as a small company now, when you are a small company, if you are dealing with what? A large company or a medium company, it is expected that that medium or large company That means that medium or large company that you want to sell now. You as a small company, a large company want to buy something from you. You are the seller. Let's say A is the seller. Let me use this. Let me use this Z to illustrate so that I'm coming. Network. Can we see the Excel I shared?
Yes, sir.
Let's say seller now. Look at it. Seller A. This seller A is a small company. Small company. I'm selling to another company, XYZ. This XYZ is what? Big company. It's a large company. That's it. So because this, so that means if I'm selling to this person is going to what? And by law, expected to what? To charge what? VAT. That means seller A, which is a small company, is expected to charge VAT. Abi? Before on that item you want to sell to XYZ, which is the big company.
Sir, I'm confused here. I thought
Look
you
at
said
it.
as a small company, they are not supposed
And
to
now
charge.
I just used that illustration first. Look at it.
Okay.
Let's say we have these two companies now. This is the seller A. Assuming this seller A is not a small company yet. It's not a small company yet. And XYZ, another company. If this seller A is selling to XYZ, seller A, before anything is selling to them, he is going to charge what? VAT, Abi? On that item, Abi?
Yes,
Is
sir.
that also? Yeah. So assuming seller A is not a small company now. So that means by law, seller A cannot charge XYZ. Is that not so? Because the law has stated that what? A small company cannot charge VAT. So what the law now says that it is the duty of XYZ now. Look at it. It is the duty of XYZ to serve account. XYZ will now account for that VAT themselves.
Okay.
They are going to account for the VAT that this person is supposed to charge. They are going to account for that VAT on that transaction by what? By themselves. How are they going to account for that VAT? Assuming the transaction is supposed to be 25 million naira. Let's say, okay, let's say 22 million, which is less than the threshold. So that means this, before paying XYZ, this 22 million, they are supposed to charge what? Additional VAT on this amount. That additional VAT that they are going to charge, they are not going to pay it to what? To this seller A. They are going to retain that amount. You know, if the invoice amount is 22 million, if they charge VAT, it will, let's say it will now become 22 million and 50, for instance. So that means by the time this 22 million and 50 will be the total cost to XYZ Limited. This total cost now, the value of the assets is 22 million, while the value added tax is 50 million. That 50 million that is value added tax, it will be the responsibility of XYZ himself to what? To account for that money and remit it to what? To the relevant tax authority. Why? Because what? This company is not what? Is not mandated to charge. So that this transaction will not what? Will not avoid what? Will not avoid the value added tax. So that's what they mean by what? Self-account provision. So in that instance, what they mean by the self-account provision is that when you are dealing with what? With a taxpayer that is not expected to charge VAT, it is expected that you are dealing with that taxpayer, you must what? Account for that what? For that amount of VAT yourself, and what? And remit it to what? To the relevant tax authority. Also, if that taxpayer that is selling something to you, if that taxpayer is also what? A non-resident.
Sorry, sir.
Yeah.
Because we are to pay on his behalf.
Yes. No. That amount is you that is also, hey, you are going to pay on his behalf. Thank you. You are to pay on his behalf.
That would be double payment.
No. It's not double payment. You know, this VAT now is an additional, an additional value to what, to any goods you are buying or any services you are buying. The value of that item is 20,000 naira. But because of the VAT, they will add VAT to it to become 20,500. That 500 is the VAT amount. That 500 is you that want to buy, that you are also going to pay that additional 500 as VAT. Do you get it now?
Yes.
So him, by the time you want to pay him now, instead of you know that if you want to pay him, you are supposed to pay him that for 20,500. But because he cannot what, he cannot deduct that money, and he doesn't have a right to what, to deduct. So you now what, when you now want to pay him, you just pay him only the invoice amount. That 500 that is the VAT amount will now be what, will be remitted by you on his behalf. That's what they mean by self-accounting provision. You are going to self-account for that VAT yourself, because the person cannot what, does not have the power to deduct. I hope it's clear to us. Also, where assuming the taxpayer is also a non-resident, he has no office or no base in Nigeria, you that is dealing with that non-resident, you are also expected to self-account for that for that value-added tax, and also remit it to the relevant tax authority. The reason for this is that so that transaction will not avoid VAT payments. Because if they don't do it that way, that transaction is going to avoid payment of VAT. So in order to make sure that that transaction will not avoid payment of VAT, so that means you must self-account for that transaction. And when you are self-accounting for that transaction, you are not going to include it as part of your own normal VAT. It's going to be what, on a separate return, which will be different from your own normal VAT that you are charging. So I hope we got that. So it's going to be on a separate return, which is called self-accounting return. So if you are now buying goods, is it all goods that are VATable? No. There are some items that are exempted items. So you may be asked, most time when they ask questions, the examiner usually asks to list out 3 or 4 items that are exempted. So goods, the first one, we have goods exempted. We have basic food items like your gari, beans, rice, basic food items that are basic. The food items that are basic does not include when you now go to hotel now. It's no more basic. You now go to hotel, then they have what? Because when going to hotel, that food has already been what? been refined by the hotel. It is no more basic. But you went to the market, my 12 market. You went to market to go and buy what? To go and buy gari, to go and buy pepper. Those are what? Basic food items. It is exempted from VAT. Or you went to Mama Put to go and eat. That's also what? Basic food item. No much value has been added because there is no FEC in wherever you want to go and eat. Then we have medical.
But eatery is added.
Yeah, eatery is part. Yeah, eatery. When you now go to eatery now, it is no more basic again. When you go to eatery, no more basic. Because they have added value. You are sitting in a comfortable area. So value has been added. But when you go to a booker, some of the bookers, they may not even have good chair, good seat to sit down. But a standard booker, no, we are not talking of a standard booker here. But eatery, when eatery is already a standard, so value has been added. Let us take note. We have for all medical and pharmaceutical products. Because government, they want people to live early. So when you are buying drugs, or when you go to hospital, it is not no VAT. Books and educational material, they want you to learn. So no VAT. Baby product, they want the population to also grow. Oil export. In some textbook, you see it as all export. Please, what you have here, what is exempted is oil export. Oil. This our crude oil that is usually extracted in Nigeria and exported, no VAT is charged on it. Why? Because what? Because Nigeria adopts, who can remind us the principle that Nigeria adopt again?
Destination
principle. So that means when you are exporting oil from here, that means that oil is expected that it's not going to be what? Use what? Here in Nigeria. It is when anyone you now imported back that will be what? Charge value added tax. We now newspaper and magazines. We have agricultural equipment and products, plant machinery and goods imported for use of export processing zone, plant and machinery equipment utilization of gas downstream, tractor plow for agricultural purpose, fertilizer, locally produced, vegetable oil. This one was introduced in Finance Act 2020. Motorcycle, bicycle and their spare parts, corporate bond and security, life insurance, locally manufactured sanitary pad. All these pads that were manufactured locally is also what? Pad, tampon, commercial aircraft, commercial engine and aircraft spare parts, commercial and residential rent. Because when we did definition of goods earlier, under the law, it has been stated that what? Goods exclude what? Land and building. Service also exclude what? Land and building. So any rent you are paying now, before now, is what? Exempted from VAT. Before now, it's usually caused controversy. So the Finance Act 2020 as well clarified that with controversies. We also have some services that are exempted. So which are medical services, services rendered by microfinance bank or mortgage institution, play and performance conducted by educational institution as part of learning. Look at it now, all exported services, any services that is not going to be what? You are not providing for somebody that is what? Resident in Nigeria. You are providing it for an outsider. No value added will be added to it. Shared passenger transport services. All these are our buses. Transport. All these are our transport buses, BRT buses, all those buses, no value added tax. So because of their shared for what? Transport services. Tuition and educational organized for non-profit making organization. Tuition paid for nursery, primary, and secondary education. Interest for loan. Interest for bank deposit. Airline transportation tickets issued and sold by commercial airline registered in Nigeria. Hire rental or lease of tractor, plow, and other agricultural equipment. When you hire agricultural equipment, because government, they know that for doing agriculture, you want to provide food and services. Apart from exempted goods and services, we also have some items that are called zero-rated. Please, the reason why they call them zero-rated is that they are VATable, but their rate of VAT, because of their nature, the rate of VAT on them is what? 0%. That's why they call them zero-rated. They are VATable item, but the rate is 0%. What are those? We have a non-oil exports. Non-oil exports. When we did up here, under exempted, we have what? Oil exports. So zero-rated now. Under zero-rated now, we now have non-oil exports. That means it is not compulsory that when you want to export item, it is only items that are exempted that you want to export. You may also be in what? In position of exporting what? Exporting item that is liable to VAT. So when you are exporting item that is liable to VAT now, the rate will now be what? 0%. Because what? It will be what? Zero-rated. Because you are going to, for exporting it, that means it's not going to be consumed here in Nigeria. So, but that item you want to export is what? VATable. But because it's not going to be consumed in Nigeria, the rate you are going to apply will now be what? 0%. That makes it to be what? Zero-rated. We have goods and services purchased by diplomats. So diplomats are those people, foreign representative of foreign country, representative of UK in Nigeria, representative of China in Nigeria, their ambassador here in Nigeria. Any goods that they purchase, once they can establish that they are diplomats, will not be what? Will not be liable to VAT. Why? Because of their tax are payable to their home country of residence. They just come here for the purpose of trade to represent their country. Goods purchased for use in humanitarian donor-funded projects. Like during COVID now, all those goods that were brought, that were purchased for distribution as relief, will not be what? Will not be liable to what? To value-added tax, because it's for what? Woman-funded what? Projects. So it will not be liable to VAT. And it's not because it's not for the purpose of a profit making. So basically, what are the differences between this zero rated and what? And exempted? Is that when an item is zero rated, any input VAT you suffered on them, you will be what? Will be refunded back. But when an item is exempted, any input VAT you suffered on them is what? Is not going to be what? Refunded back, because what? They are exempted from payment of VAT. Then we have some items that are what? Non-VATable activity, wages and salary. The wages and salary, our emolument that we collect from our employer is not VATable. The only tax they charge on it is what? Payee. Hobby activity, you are doing your normal hobby activity, as in private transaction that is private, that relate to you. So house rent is also commission on turnover. So you are selling now, they are now giving you commission as a result of that sales. It's also not what? VATable. So all those activities are not what? VATable activity. Please let us take note of that. So those are activities that are not VATable. So the major thing that is under this VAT, I'm going to move straight away to page 10. So we have what? Method of calculating VAT liability. Method of calculating VAT liability. Basically, there are three methods that we can use to calculate VAT liability. We have invoice credit method, we have subtraction method, and addition method. Those are the three methods. Invoice credit method, subtraction method, and addition method. Three methods that can be used to calculate VAT. So under the invoice credit, what do they mean by this invoice credit? Is that what? You look at you calculate your total output VAT. Under invoice credit, the total output VAT will be calculated. You less your total input VAT. So the resulting figure will give you what? The value added tax, which you are going to apply what? The VAT rate. So look at under the invoice credit method. Let us look at it. What are they saying? So under the invoice credit method, can we see the Excel sheet? Yeah? You look at what? The total, you look at your total output, VAT, you get the value for the total output VAT, you less total input VAT, you get the value for that, you now less it from the output VAT. So the resulting figure will give you value added. This value added, the resulting figure now, is what you are now going to apply tax rate. What is the tax rate? At what? What is the rate of value added? 7.5%. So the resulting figure now will now give you what? The value added tax. We give you what? The value added tax. That's what they call what? Invoice credit method. And this method is what is adopted in Nigeria. This is the method that we use here in Nigeria. So that is invoice credit method. That's the method we use in Nigeria. Apart from the invoice credit method, so the essence of that, please, in any question given to you by the examiner, where the examiner does not mention of any method, please, the method to be adopted will be what? The invoice credit method. So that is the method we adopt in Nigeria. The second method we have was the subtraction method. Under normal circumstances.
Hello, sir.
Yeah?
Sorry, sir. Yeah. My question is that this we know that output is the one on your own sales and input is the one on purchases. Yes. So now this input and output, it has only to do with that cost of business. Like let's say you are selling finished goods and then you have to buy raw materials. So
don't worry, we are still going there. Don't worry. We are still going to attend to that your question. This is what we are going to do after this. Because not all expenses will form your input VAT. Don't worry. It's the next. We are going to talk about it.
Yes, sir.
Then the next one we have is what subtraction method. For that subtraction method, under normal circumstances, where you have the same question, the value added tax you are going to get under what? Under the invoice credit method and the subtraction method will be the same. How does the subtraction method arises? Under that one, you look at your total. It's just for you to look at your total sales. Look at your total sales. You look at the total sales. Then you less total purchases. Total purchases from your total sales. You less total purchases from your total sales. So that will give you what is called value added. So this value added now, this value you got, you now apply what? Apply tax rate of how many percentage? At what? 7.5%. So to get what? The value added tax. So under normal circumstances, when you have the same information, the value you arrive at under what? Invoice credit method will be the same that you are going to get under what? Under the what? The subtraction method. But this method is not adopted in Nigeria. It is only where the examiner asks you to use this method that it should be what? Adopted. Please let us take note of that. The third method is what? Is the addition method. This one is not adopted at all in Nigeria. And you can also be asked, how does this one work? It's by, you look at what, by adding all factors of production. You add all the factors of production, all the reward that will be created by all the factors of production. The total reward created by all factors of production will give you what is called what? Value added. So, and who can tell us what are the factors of production? Who can remind us what are the factors of production?
Land, labor.
Yeah,
Capital,
land, labor,
entrepreneur.
capital, and entrepreneur. What is the reward for land?
Rent.
Then what is the reward for labor?
Wages and salaries.
What about entrepreneur?
Profits.
Then, and what? The third one is what?
Capital.
Capital. Yeah. So all the reward received by what? The various factors of production will be added together to get what? To get what? The value added. So after you added them, you now what? You now apply what? The tax rate. So to get what? The value added tax. This one is not adopted in Nigeria. Let us take note. But you may be asked to what? To calculate it where the examiner asks you. But where the examiner did not mention any method, the method to be used will be which method?
Invoice credit method.
Invoice credit method. Take note of that. Then, so how do we now know the expenses to be included in our input VAT, which is the question you were asking before?
Yes, sir. Yes.
How do we know the expenses to be included in our input 2-4? Okay. Màá béèrè lọ́wọ́ ẹ̀. Tax clearance náà gan-an fẹ́ ṣe correction lórí ẹ̀ náà. Lórí tax clearance. Tax clearance tẹ́tẹ́lẹ̀. Bẹ́ẹ̀ ni máa fẹ́ ṣe meeting àbí? No, ẹ bá ti ṣe national ID card yẹn náà ni. Lẹ́ máa fi lè ṣe lẹ́ máa lè fi ṣe ẹ bá ti ṣe national ID card yẹn. Màá béèrè lọ́wọ́ ẹ̀ nǹkan tó bá sọ màá yẹ kẹ́ mọ̀. Okay. Hello.
Yes, sir. I can hear you.
Sorry about that. Somebody called me. So as I was saying, how do we know the expenses to be utilized and what for as part of input VAT? As far as the expenses is concerned, we have a revenue expenditure and capital expenditure. We have two categories of expenditure: revenue expenditure and capital expenditure. Revenue expenditure, those are expenditure that form the day-to-day activity, that they are recurrent expenditure that organization will not do without. They are expenditure that you incur year in, year out.
We are
that
not
are
seeing the
they,
lecture note again. Excuse
yeah?
me, sir. We are not seeing
What
the
did you,
lecture note.
okay, you are not seeing the lecture note. Sorry, let me reshare it. Okay. Can you see it now?
Yes, sir.
Yeah, thank you. So revenue expenditure, those are the expenditure that will form the day-to-day activity of the what? Of the taxpayer. That is expenditure that you will not day-to-day, every month, you are going to incur those expenditure, like we're doing repairs, like payment of your wages and salaries. Your employee wages and salaries is what? Is on a monthly basis. They are what? Recurrent expenditure that are recurrent every month. And for this revenue expenditure, we have revenue expenditure that it is divided into two forms. We have direct and indirect. Please let us take note of that. We have direct revenue expenditure and indirect revenue expenditure. Let us note that first. Then we also have another expenditure that is what? Capital expenditure. Capital expenditure are what? They are those expenditure that relate to what? Acquisition of what? Non-current assets. When you are buying assets, you are buying land, you are building, you are buying motor vehicle. Assets that will last for what? Long period of time. They are not what? Frequent expenditure. They are expenditure that what the organization incur
Like
on
rent.
what? Yes. No. Rent is even what? Rent is a yearly expenditure. Expenditure that maybe like now, if you buy a motor vehicle this year, that motor vehicle will not be 40 for next year. It is not compulsory that you are still going to buy another one. It is what expenditure that will last for that you are going to that will last for what? A long period of time for asset that one. And for this, please, for capital expenditure, any value-added tax suffered on capital expenditure will not be part of the input VAT. That will be deducted from your output VAT.
That's what I
Hear it
understood.
again. Any VAT relating to capital expenditure, any VAT you pay on capital expenditure is not going to form part of the input VAT that you are going to deduct from our what? Our output VAT. That VAT will be added as part of what? The cost of the asset. You are going to add it together with the cost of the asset, and what? You are going to claim what? Capital allowance on it. Because you are going to claim capital allowance on it, you cannot what? Claim it as what? Input VAT again. If you are claiming it as input VAT, that means you are going to be claiming it twice. So any revenue that is what? Capital expenditure in nature will not be what? Will not be part of what? Part of our input VAT. For instance, let us look at an example. For instance, let's say we have an hotel now. As an hotel, they will need some equipment that will be for non-current. They are going to buy bed, Abi?
Yes, sir.
They are going to buy bed. They are going to buy air condition. All those items are what? They are what? Items that will last for what? Capital expenditure. More than 1 year, they are capital expenditure. Any VAT they incur on those what? On those
purchases.
Expenditure on those purchases will not form part of your what? Input VAT. Please let us take note of that. That is for capital expenditure. So let us now go to revenue expenditure now. I told you revenue expenditure is what? We have a direct and indirect. Please, only the revenue expenditure that is what? That is direct. Only the one that is direct to what? To that what? To that production will be what? Will be deducted from where? From our output VAT. Who is that now? Please mute your mic, please. Only the what? The revenue expenditure that is direct to production will be what? Will be deducted from what? Will form our input VAT. The indirect one will be what? Will be expense, will be added as part of what? Part of the expense, cost of the expenses that will be what? That will be charged to profit and loss account. So that means when you are calculating VAT, the input VAT you are going to remove will only relate to what? the one that is what? Direct what? Revenue expenditure. Do we get that now? So let us look at an illustration the same way I use an hotel for capital expenditure. Well, as an hotel also, we said you are going to buy bed and air condition. Those are capital. It's not going to be part of our input VAT. As an hotel, you also need what? Some item that you need for day. You are going to buy drinks, Abi?
Yes.
That you are going to be selling. As an hotel, if you are engaged in food, you are going to buy food items. Is that also? Food items that you are going to use to cook that food that you want to sell. Is that also? So all those things, you know that those things for buying drinks are part of your what? Normal daily activity. That food you want to sell is also part of your what? Normal daily activity. Those are what? Direct expenditure. Any VAT you incur on them will be what? Will be part of your input VAT. As an hotel also, you also what? Hotel, you also engage what? The service of what? Lawyers. Abi?
Yes,
you also
sir.
engage the service of what? Auditor. You engage the service of auditor. You engage the service of some other professionals. Those professionals also, you also pay them what? On a yearly basis for the services they render to you. So that amount you pay to those professionals is not what? Is not direct to your production. Do you get it now? That is what? Indirect. So any VAT you suffered on what? On those items will not form part of your what? Your input VAT.
Okay.
I hope it's clear to us. Please, let us get that. So the only one you are going to remove will be the one that relates to what? Direct revenue expenditure. The one that is for indirect revenue expenditure, in the case of the example I just gave for hotel, the lawyer they engage, any VAT they suffered as a result of engaging the lawyer, the auditor they engage, any VAT they paid as a result of that will not form part of their input VAT, because that is not what their normal what activity. That one will be what? Will be taken to what? To profit or loss. Show you what?
Then, sir.
So that is what. So then we have what? Imported goods. When you import goods, because what? We adopt what? Destination principle. It is assumed that what? If you are bringing an item from abroad, that means that item is going to be what? It's going to be consumed here in Nigeria. Is that not so? So as a result of that, that item will be liable to what? To value added tax. So all importation are what? Are liable to what? To value added tax. So let us take note of that. In the question, you may also be given information about inventory. Inventory, please, where you are giving information about inventory, that inventory is stock. When you are giving information about stock, you also need to make what? Adjustments. How do you make the adjustments for inventory? By adjusting both what? The opening inventory and what? And the closing inventory. So for inventory, you add what? You add purchases. Sorry, inventory, you add opening inventory. You add the value of the opening inventory to your purchases. Then you have your purchases. Then you have add order, if there is any other direct cost. Then you now less closing inventory. You less closing inventory. So the value you arrive at now, the value you arrive here now, is now what you are going to base what? So which is what? The cost of goods sold. Is what you are going to base what? The value added tax, the rate, the value added tax on. Please, that is where you are, when you are giving what? Inventory in the question. Please let us take note of that. Where the question provides us with inventory. So you are going to adjust that inventory with what? Opening inventory, you add the opening inventory and what? Less the closing inventory. So the value you arrive at will be what? The value that's what? that value-added tax rate will be what? That the value that will serve as what? The purchases that the value-added tax will be what? Will be applied upon. So after that, you may also have a situation whereby what? You may be giving discounts. Those have been what? Explained thoroughly here. So where you have discounts, where the first one, where a discount is offered for prompt payment, VAT is chargeable on the net amount. Where you are supposed to sell an item for 200 naira, but because you want the man to pay on time, based on your agreement, he's supposed to pay that 200 naira in the next 3 months. But you want him to pay, you not tell him, if you are paying within this month, I'm going to collect 180 naira from you. The value-added tax will be charged on what? On the net amount, which is what? The 180 naira. Please, let us take note of that. Not on the what? 200 naira, because the 200 naira is not what the supplier received. The supply made on contingent discount times, for example, depending on what specific level of purchases in a period, must be invoiced with VAT based on the full amount. And adjustment made when the discount is earned. When goods are sold to staff, this one is also another one. That is, you are making what? A supply on what? On a condition. On a condition that, okay, this supply, if, for example, depending on what level of purchase, this supply, we are going to give you the total supply whenever you pay so amounts. So that, when you are calculating the VAT will be calculated on what? On the total amount paid. Please take note of that. VAT will be calculated on the total amount paid. Then we also have, when goods are sold to staff at a discount, VAT is only due on what? On the discounted price. Please. It is also because when you are selling the goods to staff at a reduced rate, you are supposed to be selling the goods is worth 200 naira as the selling price. But because it's the staff that want to buy it, you are now selling it at 180 naira. That does not mean that goods will not be liable to VAT. You are also going to charge VAT. But you are going to charge it on what? On the discounted rate, and not on the what? On the normal selling price, because that is what the buyer is what is paying. Then goods supplied under a hire purchase agreement are chargeable on what? On cash selling price at the start of the contract. When you are, we talk about hire purchase also when we did capital allowance. The same thing under this VAT, where that goods is going to be supplied on hire purchase, where assuming you are not going to supply everything. So when you want to calculate the VAT, just calculate the cash price. The VAT will be based on what? On the cash price of what? Of that goods. Then we also have what? Where a trader charges different prices to customer paying cash and those paying by other means. The VAT due in respect of each standard rate says is the full amount paid by the customer. Where you have different rates for customer. If you are paying so if you are buying 200, you pay this amount. If you are buying 100, you pay this amount. So the VAT will be based on what? On the value paid by what? By the customer. Please. When goods are permanently taken from a business for non-business purpose, get this very well. When goods are permanently taken from the business for non-business purpose, tax must be accounted for on the cost, not on the selling price. You have bought a goods that, okay, that goods, you are supposed to use it for the purpose of the business. So, but because you are now one of the directors, you now took it for your own personal purpose. You must also charge VAT on that one, on that particular goods. When you are charging VAT, you are not charging it on the selling price, but you are going to charge it on the cost. Why? Because you did not pay any money. But the value of that item to the organization is the cost of what? Of that. So you must also charge VAT on what? On that item. If services bought for business purpose are used for non-business purpose without charges, then tax must be accounted for on their cost. But the tax to be accounted for is not allowed. It's not allowed to exceed the input tax deducted on the purchases of the services. Look at it, you have bought the services for what? For the purpose of what? For non-business purpose. That services you receive is not for the purpose of the business. It's for the purpose of another. It's for another purpose. then you must account for it. Tax must be accounted on their cost. When you're accounting for the cost, tax, that is the value-added tax, you must also account for it. But you are going to account for that. The tax you want to account for it must not be more than what anything you have suffered on that what on that item. So please let us. These are the rule guiding one. Once you can know this rule, any question on VAT will be what will be a thing of the past. So let us know this rule very well. Then before we go, we also have what is called VAT returns and remittance. Yeah, which we said is part of what you have stated earlier before. You expected to what? To remit it on or before what? 21st day of what? Of the following month. Failure to do that, you'll be liable to what? To penalty and interest. Yeah. There is also what? VAT refund. When will a taxable person be entitled to VAT refund? Who can tell us? We mentioned it earlier.
When the person does not have input VAT.
Yes.
I mean, yeah,
Which other?
Which
other way?
When the revenue is not up to 25 million.
Yes, it's the same. That's what it's the same thing that when the revenue is not up to 25 million. Yes. Yeah. What you said earlier, you said when the person does not have what? Input VAT. Is not correct?
Output
VAT. Yeah, it's having only input VAT. So that is the situation of what? In that case, you have what? Small company. But there is one particular point I mentioned when we started. Who can remind us? There was one particular point I mentioned. I told you when what? When your input VAT is more than your what? Output VAT. That's it. What you suffered for that month is more than what you collect for that month. That means you are going to what?
You're going to get the refund.
Government is owing you. So they are owing you. Then how do you get this refund? And I told you, this refund, if there's no way of giving it back to you in form of credit, it must be what? Refunded within how many days? It must be refunded within how many days? Who can remind us? I mentioned it earlier. It must be refunded within 90 days.
90 days.
Once it has been established that the refund is genuine. So how do you get this refund? It is either by what credit method. That is any money you want to get refund for this month now. You now look at it next month. So how much are you supposed, maybe you want to get refund of 100,000 this month. In next month, you are supposed to pay 120,000 to FRS. Just remove your 100,000 from that 120,000 and pay them the balance of what? The 20,000. It can also be by direct cash refund. You can also tell them to what? If you want to get cash, you have to wait what? After it has been established, it must be refunded within how many days? I just mentioned it, not 90 days. Then it can also be by combination of both what? Credit and what? And cash method. Maybe what? Combination of what? Of the two items. So can also be what? The way that what refund can be what? Can be refunded for VAT. So any question? Any question? Any question?
No question, sir.
Yeah, so please. So we are going to start with we are going to continue with it next week and look at the computation aspect. But just try and get the way I explain all those ways to calculate. That is the brain behind the calculation. Once you can get those analysis, that whether an expenditure is revenue or capital, and if it is revenue, whether it is direct or indirect. So you have to look at that and in order to know which revenue are you going to put or which one are you not going to put. Then before we go, we also have what is called VAT visit. I mentioned earlier that the FRS VAT enforcement and practice under page 12. They have a right. The tax law gave them a right to visit your organization. That is the reason why we said where the law stated that when you have various outlets, you must also register those outlets separately with the nearest FRS office, so that's they can visit your company to come and verify your record. So the tax law gave them a right to visit your company from time to time. they can come to your company and what to come and look at your compliance, the level of your compliance, to come also come and look at your book, whether what the amount you deducted is what you are remitting or not. So they have the tax law give them a right to do that. They can also carry out what is called VAT drive. This one is what carry out on a periodic basis. They will just select some company and say they want to visit those companies to look at. This one is usually from where? They will go from the headquarters to look at what is the VAT collection procedure of that company, whether they are complying with what collection procedure or not. The law also gave them a right to carry out audit and investigation. When they come for that VAT visit or VAT drive, when they find out that you have not been complying, they will now they will come for, they will write you that they want to carry out VAT audit and investigation. They have a right to carry out VAT audit and investigation to look at your record as far back as 6 years back, to look at the record of the taxable person. So if they find out, by the time they come for VAT visit or VAT drive, if they find out that the company has been engaged in criminal activity in relation to VAT, they will carry out what is called VAT investigation. But where there is no criminal activity, they will carry out what is called VAT audit. This money now, after FIRS collected this money, FIRS will not hold on. The federal government will not hold on to it alone. It is shared among the various tiers of government. I have mentioned it here before. 50% goes to federal government, 50% to the state government and FCT, and 35% to the local government. So that's how the VAT money is being shared. So please let us so those are the information. So please, we are going to stop here for today. So next week we are going to continue with the value-added tax and around the top and look at one or two other more topics that we still have outstanding. So any question? Any question? Any question?
For now,